On Wednesday, the 19th of March 2025, apart from the ongoing Trump trade war tantrum, Ukraine and Gaza war or ceasefire, all focus of Wall Street was on the FOMC meeting, the Fed's policy decisions, the summary of economic projections, and Chair Powell's comments. As highly expected, the Fed holds all of its key policy rates. But the Fed also reduced further the pace of QT, or balance sheet runoff for U.S. Treasury bonds, or UST, from $25 billion per month to $5 billion per month from April's 25 onwards. Overall, the Fed kept the federal funds rate unchanged at 4.25% to 4.5% during its March 2025 meeting, extending the pause in its rate cut cycle that began in January 2025. FOMC policymakers noted that uncertainty around the U.S. economic outlook has increased, but still anticipate reducing interest rates by 50 BPs in the second half of this year. Meanwhile, the U.S. real GDP growth forecasts by the Fed were revised lower for 2025 to 1.7% from 2.1% seen in December projections. The U.S. economy has expanded 2.8% in 2024 against the potential of 3.0%. Fed also now sees comparatively higher inflation and higher unemployment for 2025. In brief, the Fed now sees stagflation as it projected lower economic growth, higher inflation, and a higher unemployment rate for 2025. Fed holds rates as unanimously expected, signaled further tapering of QT, and virtually blamed Trump policy uncertainty for the stagflationary U.S. economic outlook. Fed Chair Powell clearly said that the Fed is not in a hurry to cut rates until the latter half of this year, as it has to balance its dual mandate of minimum price stability and maximum employment, even amid Trump policy uncertainty in trade, tariffs, immigration, fiscal policies, and regulations. But still, Powell sounded less hawkish on Trump tariffs and the Trumpflation narrative. Powell was cautious in his assessment of how President Trump's trade war might shape the economy, citing the possibility that tariffs' impact on consumer prices would be transitory. Overall, Powell played safe and avoided a direct head-on collision with Trump on policy issues. Fed is now cutting rates while doing QT. But these are two contra-monetary policy tools. As a result, bond yields remain elevated at around 4.50%, and the real economy may not be getting the full effect of a 100 BPS rate cut in late 2024. The market usually discounts Fed rate cuts well in advance, in line with regular Fed talks and official dot plots. From April, the Fed will slow the pace of QT, that is balance sheet reduction, from $25 billion to $5 billion in USTs, which may reduce bond yields or borrowing costs slightly. The Fed may effectively close the QT first by December 25 at a BS size of around $6.50 trillion from its present size of $6.75 trillion. From April 25, the Fed will reduce QT rates from $25 billion to only $5 billion, which is not significant, and may finally close the QT for UST by December 25. But the MBS runoff, MBS QT, will go on at the official pace of $35 billion per month. Nowadays, UST matters to US bond yield, not MBS. Thus, Fed will permanently remove MBS from its balance sheet to replace it with USTs in the future in a calibrated manner, which may be equivalent to a mini QE. Fed may keep the BS size at around $6. 50T, which would be 22% of projected nominal GDP, around $30T by 2025, which may be an ideal level for the Goldilocks nature of the US economy and may not cause another repo or funding market crisis, as we have seen late 2019 under Trump and Powell, 1.0. Now Fed is effectively in the last stage of QT tapering or balance sheet runoff for USTs. To fight a highly probable U.S. stagflation or even recession-like economic situation amid the Trump trade war tantrum, the Fed may first close QT fully by December 25, and also resume the rate cut cycle for 50 BPS cumulative in 2025 from June. Fed may provide a definitive plan to end the QT in its June-September 25 meeting, and close the same by December 25, and also cut rates by 25 BPS each in June and December 25. But if the concern of a Trump session intensifies further and the employment situation deteriorates meaningfully, and unemployment surges over 4.5%, the Fed may also cut another 25 BPs in September 25. At the present run rate and any potential impact of a moderate to severe Trump trade war, the U.S. core inflation may dip towards 2.0% targets only by mid to late 2026 or even in 2027. Various private economists and economic think tanks estimated at least a 1% boost in U.S. inflation and a $2,400 per year higher cost of living for a standard household as a result of the Trump tariff tantrum. Subsequently, the rate of price rise or inflation will be smaller, but the higher cost of living may be permanent if Trump's tariff policy remains in place under different administrations. On Wednesday, March 19, 2025, Wall Street futures and gold surged on a less hawkish Fed hold. Fed Chair Powell downplayed Trumpflation as transitory and sounded less hawkish than expected. But on Thursday, March 20, 2025, Wall Street futures and gold slumped, while USD surged as Trump warned Fed is making a policy mistake by not cutting rates now. Trump virtually pointed out that his potential reciprocal and other sectoral tariffs from the 2nd of April are set to destabilize the U.S. economy into stagflation in the transition period. That is, Trump warned of short-term pain for long-term gain. On late Wednesday, the 19th of March 2025, U.S. President Trump wrote in his truth handle after Fed hold, "The Fed would be much better off cutting rates as U.S. tariffs start to ease their way into the economy. Do the right thing. April 2nd is Liberation Day in America." Earlier, Wall Street futures were boosted by a report that the Trump admin is proactively negotiating with other countries having the targets of reciprocal tariffs to reduce their exorbitantly high tariffs on U.S. goods so that the U.S. doesn't have to impose higher tariffs on exports from those countries. But now, it seems that Trump may not oblige and he may be intentionally creating an economic disruption to force the Fed to a quicker rate cuts and end of QT fully. Trump may be trying to force the Fed for preemptive rate cuts by inducing the U.S. economy into a stagflation, or even an all-out recession. The late 2019 U.S. funding market jitters and repo surge was an indirect fallout of economic uncertainty amid Trump's China trade and Cold War policy. This time the stake is much higher. The market hates the cycle of recession, from the 2008 subprime housing crisis and global financial crisis, to the COVID-induced recession in 2020, and now a looming Trump session. The financial market is now no longer controlled by the Fed. The market is now dancing to the Trump tariffs tunes, Trump's whimsical mood, comments, and bellicose policies. Tariffs create a supply shock, pushing prices up. This has a domino effect on the overall cost of living. Also, never-ending geopolitical tensions in other parts of the world, like the ongoing conflict in Ukraine, Gaza, Middle East, add to this uncertainty. Investors become risk-averse. They pull back from volatile markets, seeking safer havens. This flight to safety can impact currency exchange rates, bond yields, precious metals like gold, and stock markets globally. The takeaway? The market is not a sterile environment. It's a living, breathing entity influenced by a myriad of factors, many beyond our control. Understanding these forces, however, can help us navigate the turbulent waters and make more informed investment decisions.